Welcome to Seeds of Wisdom team. The Oracle of Omaha, Warren Buffett, is a legend in the world of finance and investing. He's famous for his investing prowess, having built a fortune through smart strategic decisions, but he's also known for his simple wisdom and practical advice that resonates with both novice and seasoned investors. One of his most important lessons: cash is king. This principle underscores the importance of liquidity in any business. Buffett understands that cash flow is the lifeblood of any business, ensuring it can meet its obligations and invest in growth. It's the actual money flowing in and out, reflecting the true financial health of a company. Earnings, on the other hand, can be manipulated through various accounting practices. They're based on accounting rules, not cold, hard cash, and can sometimes paint a misleading picture. Investors often get caught up in earnings reports, focusing on short-term gains. But Buffett focuses on the real deal cash flow, which provides a clearer, more reliable indicator of a company's health and potential. It's a more reliable indicator of a company's health and potential, offering insights into its ability to sustain operations and grow. So, if you want to invest like Buffett, follow the cash. Prioritize companies with strong, consistent cash flow. It's the key to long-term success in the market, ensuring that your investments are grounded in solid financial fundamentals. Cash flow is simple: money in, money out. It's the fundamental pulse of any business, ensuring that operations continue smoothly. It tracks the movement of cash within a business, providing a clear picture of financial health and stability. Think of it as a company's bank account statement, detailing every transaction and showing the net balance. There are three main categories of cash flow, each serving a unique purpose in the financial ecosystem. Each category tells a different story about the business, offering insights into various aspects of its operations and strategy. 1. Operating cash flow. Cash generated from the core business operations, selling goods or services. This is the lifeline that keeps the day-to-day activities running. 2. Investing cash flow. Cash used for investments like buying equipment or selling assets. This reflects the company's growth and expansion efforts. 3. Financing cash flow. Cash from raising capital or repaying debts, like issuing stock or taking loans. This shows how the business funds its operations and growth. By analyzing these three areas, investors can get a comprehensive picture of a company's financial health, making informed decisions about their investments. Operating cash flow is the heart and soul of a healthy business. It's the cash generated from what the company does best, its core operations. Think of a bakery. Its operating cash flow comes from selling bread, cakes, and pastries. The more delicious treats they sell, the more cash flows in. Strong operating cash flow indicates the business is running smoothly. It's generating enough cash to cover expenses like wages and rent, and still have some left over. This surplus cash is crucial. It can be reinvested for growth, used to pay dividends, or kept as a safety net. Investing cash flow tells us how a company is planning for the future. It's about spending money now to make more money later. Imagine that same bakery. They need a new oven to keep up with demand. This is an investment. It costs money up front but will increase production and, hopefully, profits. Analyzing investing cash flow helps investors understand a company's growth strategy. Are they investing in new equipment, research and development, or acquisitions? These decisions can have a big impact on future success. Section 5, Financing, Fueling Expansion, and Managing Debt. This section delves into the intricate world of corporate finance, where strategic decisions can make or break a company's future. Financing cash flow is all about how a company raises and manages its money. It's the lifeblood that keeps the business running smoothly and allows it to seize new opportunities. This includes activities like issuing stock, taking out loans, or repurchasing shares. Each of these actions has a significant impact on the company's financial health and strategic direction. Think of it like managing your personal finances. Just as you balance your income and expenses, companies must carefully manage their financial resources. You might take out a loan to buy a car, ensuring you have the necessary funds to make a significant purchase, or invest in the stock market, aiming to grow your wealth over time through smart investments. Companies use financing activities to fund their operations and growth. This enables them to expand their reach, develop new products, and enter new markets. Understanding a company's financing cash flow is crucial. It provides insights into the company's financial strategies and long-term viability. It reveals how much debt they have and how they manage it. Effective debt management is essential for maintaining financial stability. High levels of debt can be risky, potentially leading to financial distress if not managed properly, while smart financing can fuel growth and create value for shareholders. By making informed financial decisions, companies can achieve sustainable success and deliver long-term value. Section 6, Cash versus Earnings. A tale of two metrics. Investors often focus on a company's earnings, but earnings can be misleading. They're based on accounting rules and may not reflect the actual cash coming in the door. Cash flow, on the other hand, is much harder to manipulate. It's a truer measure of a company's financial health. It shows whether the business can generate enough cash to survive and thrive. Think of it this way: you can't pay your bills with earnings. You need cash. The same goes for companies. Section 7, Amazon's Lesson. When profits don't equal cash. Amazon's 2014 performance provides a powerful example of why cash flow matters. Despite reporting minimal profits, Amazon generated massive amounts of cash. How? They reinvested heavily in their business, building warehouses and expanding their operations. These investments ate into their profits but fueled future growth. Investors who focused solely on Amazon's earnings would have missed the bigger picture. Their strong cash flow signaled a healthy and growing business, even without huge profits at the time. Section 8, The Bottom Line. Cash flow rules. Cash flow is king in the world of investing. Warren Buffett and many other prominent investors have long preferred to measure a company's performance by their cash flows, found on the cash flow statement, rather than their reported earnings numbers. But what exactly are cash flows, and why are they given more weighting? Cash flow represents the actual inflow and outflow of cash within a company, detailing where the money comes from and how it is spent. Cash flow is typically divided into three main categories on a cash flow statement. 1. Operating cash flow, cash generated from a company's primary business activities like selling goods or services. It reflects the day-to-day earnings that contribute to business sustainability. 2. Investing cash flow, cash spent on or generated from investments, such as buying equipment or assets or selling them. This part of cash flow shows how the company allocates funds to grow and maintain its assets. 3. Financing cash flow, cash from external sources or used to pay back financiers like taking out or repaying loans, issuing or buying back shares, and paying dividends. It represents the company's decisions around managing debts, equity, and dividends. Why cash flow is valued over earnings. Prominent investors like Warren Buffett prefer cash flow over reported earnings because cash flow offers a clearer, unadjusted picture of a company's financial health. Here's why. Transparency. Cash flows can't be easily manipulated, unlike earnings, which can be adjusted with accounting techniques to show better results. Cash flow reflects the actual liquidity and financial capability of the business. Sustainability of operations. Operating cash flow shows how effectively a company can generate cash from its core business. Strong cash flows from operations indicate a stable business model and healthy financial operations. Debt and dividend management. Good cash flow means the company can comfortably pay its debts, invest in growth, and return value to shareholders through dividends. A company with positive cash flow is often considered more financially stable and less likely to rely on external funding to meet obligations. Growth and investment opportunities. Positive cash flow from operations and investing indicates the company has both the ability and resources to pursue new opportunities or expansion, increasing the potential for long-term growth. In summary, cash flow is a direct, reliable measure of financial strength and flexibility. It shows how much actual cash is available for reinvestment, debt repayment, and shareholder returns, making it a preferred metric for evaluating a company's sustainability and resilience over earnings alone. The discussion emphasizes the importance of cash flow analysis for investors and why it's often considered more reliable than earnings alone for assessing a company's financial health. Here's a breakdown of key concepts from the explanation. 1. Cash flow. Types: O. Operating cash flow, OCF, money from core business operations. O. Investing cash flow, CFI, cash related to investments in long-term assets like property or equipment. O. Financing cash flow, CFF, cash related to funding activities such as issuing stock, repurchasing shares, paying dividends, or paying down debt. 1. Free cash flow, FCF, an honorary fourth type calculated by subtracting capital expenditures from CFI from operating cash flow. It shows the amount of cash a company has left after covering operating and investment expenses. High FCF allows for dividends, share buybacks, debt repayment, and acquisitions without raising extra capital. 2. Importance of cash flows. O. Cash flow versus earnings. Unlike earnings, which can be subject to accounting adjustments, cash flows provide a clearer view of actual money movement, which is harder to manipulate. 2. O. Quality of earnings. Cash flows can reveal the quality of a company's earnings. If reported profits are high but operating cash flow is low, it could indicate inflated earnings or financial manipulation. O. Reliability. Companies with higher cash flows usually have stable, reliable business models, as they can fund operations, growth, and shareholder returns without accumulating excessive debt. O. Comparative analysis. By comparing cash flow statements and net income, investors gain insights into a company's long-term sustainability and financial flexibility. In essence, while net income offers a snapshot of annual performance, cash flows reveal a deeper and more complete financial picture, helping investors gauge both stability and growth potential. In 2014, Amazon provides an example of the importance of cash flows over reported earnings. Despite showing a loss on its income statement, negative earnings, Amazon had record high operating cash flows, adding $5.9 billion to its balance sheet. This illustrates that while reported earnings might show losses, strong cash flow, especially from operating activities, can indicate robust business health. The three classification of cash flow. 1. Cash from operating activities, CFO. This is the most critical category for understanding a company's core financial health. It represents the cash generated directly from business operations, sales revenue minus payments for supplies, wages, interest, and taxes. OA high or increasing CFO generally signals a growing profitable business, while a shrinking or negative CFO can be a warning sign of financial struggles. A negative CFO means the company is losing money on its core operations. 1. Cash from investing activities, CFI. This reflects money spent on or earned from the purchase or sale of long-term assets, such as property or equipment. Typically, CFI is negative since companies often spend to grow their asset base or maintain their current operations. Positive CFI can occur if a company is divesting assets, which can sometimes indicate it's reducing investment in growth or raising cash through asset sales. 1. Cash from financing activities, CFF. OCFF tracks cash raised or spent through financing methods like issuing or repurchasing shares, issuing bonds, or taking on loans. A. Positive CFF shows the company is raising funds, possibly for expansion. A negative CFF means the business is using cash to pay shareholders through buybacks or dividends, or reduce debt, which can strengthen its financial position. Free cash flow, FCF, the honorary cash flow type. Free cash flow, FCF, is derived from operating cash flow minus capital expenditures, from CFI. It shows the cash left after covering operational costs and investments. Companies with high FCF can fund growth initiatives, pay down debt, buy back shares, or pay dividends, all without additional borrowing. Why cash flows matter more than earnings? Cash flows provide a more complete and direct measure of financial health. Earnings can be influenced by non-cash adjustments or accounting strategies, while cash flows show real liquidity. Analysts prefer cash flow analysis because it reveals business sustainability. Consistent positive CFO and FCF indicate a stable, self-sustaining business. Assesses earnings quality. High earnings with low or negative CFO might suggest financial manipulation or unsustainable profit sources. Indicates financial flexibility. Cash flows from operations and FCF determine a company's capacity to manage debt, invest in growth, and reward shareholders without relying on external financing. Example, comparison, Plain Bagel Co. versus Sesame Sands. Imagine two companies with identical balance sheets and earnings. While both report the same income, their cash flow statements reveal key differences. Plain Bagel Co. has high CFO and can comfortably fund growth, CFI, and return money to shareholders and creditors, CFF, indicating strong financial health. Sesame Sands has lower CFO and higher spending in CFI, requiring debt to support its operations, showing financial strain. The takeaway: checking cash flow statements alongside earnings can give a fuller picture of a company's sustainability, reliability, and ability to self-fund growth, making cash flows a vital metric for investment decisions. The explanation underscores the importance of understanding each type of cash flow and their significance when assessing a company's financial health. Here's a breakdown. Cash from operating activities, CFO. Definition: this is the cash generated from the company's main business operations, such as cash received from sales, minus cash paid for expenses like supplier payments, wages, interest, and taxes. Importance: often the most critical measure of cash flow because it shows whether the core operations are generating enough cash to support the business. A high and growing CFO usually indicates a healthy, expanding business, while a low or negative CFO can signal operational difficulties or even potential insolvency. Cash from investing activities, CFI. Definition: CFI includes cash transactions related to the acquisition or sale of long-term assets like property, equipment, or securities. Importance: CFI is typically negative because it usually involves investments in assets to grow or sustain the business. Occasionally, it can be positive if the company sells assets or receives returns on investments. Negative CFI is not necessarily a bad sign, as it often indicates reinvestment into the company's future growth. Cash from financing activities, CFF. Definition: CFF tracks cash inflows from issuing shares, bonds, or loans, as well as cash outflows from dividends, share buybacks, and debt repayments. Importance: a positive CFF suggests the company is raising funds, possibly for expansion or other investments, while a negative CFF indicates that the company is paying out funds, either returning value to shareholders or reducing debt. Regular negative CFF can strengthen financial health by reducing debt, but may also indicate fewer growth opportunities if new investments are not funded. Free cash flow, FCF. Definition: FCF is an honorary fourth type of cash flow calculated by subtracting capital expenditures from CFI from operating cash flow. It shows the amount of cash left after covering operational and investment expenses. Importance: FCF is highly valued because it represents cash available for discretionary uses such as debt repayment, dividends, share buybacks, or new acquisitions. Companies with high FCF can fund growth internally without borrowing, while those with negative FCF may struggle with cash constraints and need to raise additional funds. Why cash flows matter. Reliability over earnings. Unlike net income, which can be affected by accounting adjustments, cash flows reflect actual liquidity, giving a clear, direct picture of financial health. Indicator of earnings. Quality. High net income with low or negative CFO may suggest financial manipulation or unsustainable income. Long-term stability. High CFO and positive FCF indicate that a company can sustain and grow operations without relying heavily on external financing, which points to a robust, stable business model. By analyzing these cash flows, investors gain a comprehensive view of a company's ability to sustain, grow, and finance its operations, making cash flow analysis a valuable tool in assessing a company's overall financial health. In Warren Buffett's 2018 shareholder letter, he highlighted why investors should look beyond traditional earnings numbers. His company, Berkshire Hathaway, reported only $4 billion in net income for that year, despite making an operating profit of $24.8 billion. The discrepancy resulted from unrealized losses in investments that temporarily reduced net income on paper but didn't affect the cash generated from operations. This example highlights why cash flow analysis often offers a clearer picture of a company's financial health than reported earnings, which can include noise from non-cash items and one-time adjustments. By focusing on actual cash movements through the cash flow statement, investors get a clearer view of a company's ability to generate cash sustainably. Key insights from cash flow analysis. 1. Cash flow defined. Cash flow represents the cash inflows and outflows that impact a company's bank account, reflecting the money that has been received or paid out in reality, unlike the non-cash adjustments that can affect the income statement. 1. Amazon's 2014 example. Despite reporting a loss on its income statement, Amazon's operating cash flow reached record levels that year, adding $5.9 billion to its balance sheet. This cash flow, driven by operating activities, indicated a robust business model despite negative reported earnings. 1. The three classifications of cash flow. Cash from operating activities. CFO shows cash generated from core business operations such as sales minus operational expenses. Cash from investing activities. CFI involves cash spent on or received from buying and selling long-term assets like property and equipment. Cash from financing activities. CFF reflects cash raised from or returned to shareholders and creditors, such as issuing shares, borrowing, or repaying loans. 1. Free cash flow. FCF. Calculated as operating cash flow minus capital expenditures. FCF represents the cash left after covering operational costs and asset investments. High FCF is favorable as it shows that a company has excess cash for strategic activities such as growth, debt repayment, or shareholder returns without needing additional funds. 1. Why cash flow is often valued over net income. Reliability. Cash flows are less susceptible to accounting adjustments and more accurately reflect a company's financial health. Sustainability. High operating cash flow and free cash flow suggest a company can fund growth independently. Earnings quality. If net income is high, but operating cash flow is low or negative, it can indicate inflated earnings through non-cash adjustments. By analyzing cash flows, investors can better understand a company's core operational strength, growth potential, and financial flexibility, factors crucial to making informed investment decisions. It's a more accurate and reliable measure of a company's financial health than earnings. By understanding the three types of cash flow, operating, investing, and financing, investors can gain valuable insights into a company's operations, growth prospects, and financial stability. So next time you're evaluating a company, follow Warren Buffett's advice. Look beyond the earnings and focus on the cash. It could make all the difference in your investment decisions. Don't miss the bus and subscribe.